Okay, so what if I told you there was a way to take a market downturn, the thing that every investor dreads, and actually turn it into a real advantage for your portfolio? Well, today we're going to break down a super powerful strategy that does exactly that.
I know, it sounds completely backwards, right? How on earth could losing money on a stock actually be a good thing? But believe it or not, the answer is a huge yes. And it's all thanks to a strategy that savvy investors use all the time. It's called tax loss harvesting.
So here's the deal in plain English. It's really just about being smart and cashing in on your paper losses. You sell an investment that's in the red, and that creates what's called a capital loss. You then get to use that loss to wipe out the capital gains you've made on your winners. The end result? A lower tax bill, which means you get to keep more of your money. It's that simple. But okay, what is this strategy actually worth? Is this just a neat little trick, or does it really move the needle? Well, researchers at MIT have dug deep into this, and they have a name for the extra value it adds. They call it tax alpha.
And get this, according to a massive MIT study that looked at data all the way from 1926 to 2018, a consistent tax loss harvesting strategy added an average of 1.1% to a portfolio's return, and that's every single year. Now that might not sound like a huge number, but trust me, when that compounds over decades, it is an absolute game changer.
And here's where it gets even more interesting. In really volatile times, the benefit gets even bigger. So, during the period from 1926 to 1949, we're talking the Great Depression here, that value shot up to an incredible 2.29% per year. It just goes to show, the choppier the market, the more opportunities you have to put this strategy to work.
Now, before you run off and start selling everything that's down, hold on. There is one crucial, and I mean crucial rule you have to know about. It's called the wash sale rule, and it is by far the biggest trap for investors trying to do this.
So, the government put this rule in place to stop people from, gaming the system. You can't just sell a stock to get that sweet tax break and then immediately buy it right back. That would be, having your cake and eating it too. The IRS is not a fan of that.
So here's the key takeaway. You're basically put in a 61-day timeout window. That's 30 days before you sell, the day you sell, and 30 days after you sell. During that whole period, you, your spouse, or even a company you control can't buy back that same investment or anything substantially identical.
And believe me, this rule has real teeth. That same MIT study found that when they accounted for the wash sale rule, that average annual tax alpha dropped from 1.10% down to 0.85%. Now look, that's still a massive benefit, but it shows you just how critical it is to get this rule right.
Okay, so how do you actually do this the smart way? Let's walk through the playbook for how to successfully harvest those losses while staying on the right side of the wash sale rule and, this is the most important part, staying invested in the market.
It's actually a pretty simple three-step process. First, you sell your losing investment. Second, you use that loss to cancel out your gains. And third, this is the secret sauce. You reinvest that money into a similar but not identical asset. That third step is what lets you capture the tax benefit without sitting on the sidelines and potentially missing a market rebound.
Here's the thing. The IRS has never really given a crystal clear definition of what substantially identical means. It's a bit of a gray area. But the general consensus among tax pros is that if you choose a replacement investment that tracks a different underlying index, you're in the clear. Let me give you a classic example. Let's say you own the Vanguard Total Stock Market ETF, ticker VTI, and it's down. You could sell it and then immediately use that money to buy the SPDR Total Stock Market ETF, ticker SPTM. See, they both give you exposure to the entire U.S. stock market, but one tracks the CRSP index and the other tracks the S&P index. Because they track different indexes, they aren't considered identical. Boom, you've harvested your loss and you're still fully invested.
So, when should you be on the lookout for these opportunities? You might think tax loss harvesting is only for those scary bear markets, but the data tells a way more interesting story.
Just look at this data from Goldman Sachs. It's kind of amazing. Even in monster bull market years, like 2013, when the S&P 500 was up over 30%, more than half of all the individual stocks in it still dipped into the red at some point during the year. The big takeaway here? There are always opportunities to harvest losses if you're looking.
So yeah, opportunities are always there, but the strategy really shines and delivers the most value when markets are choppy, when there's high dispersion, which just means some stocks are way up while others are way down, and when the overall market is kind of flat or down. And we can see this perfectly in that historical data from MIT. The super volatile period from 1926 to 1949, that generated that huge 2.29% tax alpha. But compare that to the steady, calm bull market after World War II from 1949 to 1972, the benefit was way smaller. It's clear, volatility is the fuel for tax loss harvesting.
Okay, just a few quick but really important things to remember. First, the benefit you'll get is going to vary a lot from year to year. And to get the biggest bang for your buck, you really need capital gains to offset. If you don't have any gains, don't worry. You can still use up to $3,000 of those losses to write off your regular income. And any losses left over after that, you just carry them forward to use in future years.
All right, so after all that data, all that analysis, what is the real bottom line here? What do you need to take away from this?
I think this quote just nails it. This isn't some one-time trick you pull out of your hat in December. It's a systematic, ongoing discipline. It's really a shift in your mindset. You start to see market downturns not just as a risk, but as an opportunity to systematically improve your after-tax returns year after year.
By looking at market volatility through this new lens, you can unlock an incredibly powerful tool for building wealth. So the question I want to leave you with is this. Are you letting your portfolio's inevitable downswings just drag you down? Or are you going to start using them as a strategic advantage to pull ahead of the pack?